checking out the second episode of Unfuck the Poor, presented by AskALeftist.com, an anti-political and 100% pro-human website dedicated to discussing global issues such as immigration, segregation, and environmental preservation. Unfuck the Poor is available free wherever you get your podcasts. You can find the full PDF of Unfuck the Poor at AskALeftist.com, along with show notes and additional media, all, of course, free. This episode is Chapter 1 of Unfuck the Poor, and we start with everyone's favorite topic from 2021.
In the last 5 years, its stock had fallen from $40 to $5 a share.
GameStop's stock is surging.
Why is GameStop up 700%?
Retailer place game, you go in and you buy video games.
This video game store up 2,500% this year.
Gamification of trading.
As hedge fund titans lose billions to Reddit traders running amok.
GameStop.
I'm video game retailer GameStop.
GameStop.
To democratize trading. By day's end, GameStop had tanked 44%.
GameStop.
Unfuck the Poor, Chapter 1, Stocks, Bonds, and Assholes. My wife, who is much smarter than me, said this while reading about the GameStop trading frenzy in early 2021. I thought I understood this at first with the short selling, and now they're talking about the gamma squeeze and delta something, and I'm lost. My wife did understand what was happening, but because economists like to explain things in their own language, they make every financial anomaly sound like a physics paper instead of money tricks. I'm starting with GameStop because it is complicated, but the reasons it's complicated have nothing to do with gammas, deltas, or spreads. The GameStop story, 1, involves banking activity that most people find sketch, and 2, has an immense history of exploitative banking and public policy. And because it's sketch and exploitative, it's a great starting point. It's also kind of funny. I mean, GameStop, of all things. Everything about GameStop revolves around short selling, an advanced investment scheme that basically bets a company is going to fail. And everything about understanding the market revolves around the fundamental principle of a fictional, fully rational, and logical human who must act in a specific way, no matter what situation she is in. Always in her own interest, not her actual interest, but her economic interest, though to the economist there should not be a distinction. To quickly summarize, hedge fund managers were betting against GameStop stock because it appeared to be on the verge of bankruptcy. It was failing. So investors shorted the stock, hoping to profit. Short selling works like this. You borrow shares of a stock, sell them at a high price, and then buy back those shares at a lower price and keep the difference. That's it. It might not be 100% clear, but let's go on. The key thing here is that you're selling something that you've borrowed with the guarantee that you'll return what you borrowed. So say I borrow your Nike Air Force Ones and sell them for $100. Stop right there. Yes, I asked to borrow your shoes and then I sold them. It's okay. I told you I would be selling them and you said, okay, fine, but in a month, I'm going to need those shoes back. So the clock is ticking. I immediately start shopping for another pair of Air Force Ones and they start selling for $105. No good. I only got $100 for your shoes, and then the price goes up to $120, and I say, holy shit, and then it drops to $100. Okay, I can break even. Next time I check, it's $85 for a pair of Air Force Ones. Now, I could try my luck and hope that the price goes lower, but I don't. I buy that pair and give them to you. So, I sold your shoes for $100 and replaced them with a pair that cost $85. I made $15. I sold your Air Force Ones short and returned a pair to you like I promised. Now, what if the price never goes below what I sold them for? What if the price keeps going up? Like, what if those Air Force Ones are really nice and everyone wants them and they start selling for $200? Remember, I borrowed your shoes and sold them, meaning I only have the money from that sale, and I still have to give you back your shoes when I said I would. But now I'm losing the $100 I made selling your shoes, and I have to pay the $100 difference to replace your shoes. Now, would you let a friend borrow your shoes so they could sell them and make money? It might seem sketch, but if you wanted to protect yourself against your friend's scheme, you would probably put some rules in place. First of all, a guarantee that no matter what, you're getting those shoes back. Second, a deposit for the shoes. And third, a time limit. I can only make so much money this way. If I sold the shoes for $100 and got a pair for free, at most, I'm making $100. But I can lose infinite money because there is no limit to what something can be worth. And that last part is the key underlying bullshit principle of economics as a whole. Profit and loss are infinite, but only under certain circumstances. So who sets those circumstances? In the case of GameStop, Short sellers borrowed GameStop shares, sold them, and anticipated buying them back once the company failed, but a group of public peasants like me and you went in on GameStop and drove the price up to the tune of $70 billion in losses for short sellers. The New York Stock Exchange, NYSE, and hedge funds didn't like that, so the NYSE halted the sale of GameStop shares 9 times as their price skyrocketed over the week. Hedge funders and smart people really didn't like it. Massachusetts Secretary of the Commonwealth William Galvin made it quite clear that the peasants communicating with each other was unwelcome, warning that accessible retail trading and social media was, quote, diminishing the integrity of the market. So, the organization that oversees trading sets the circumstances under which the infiniteness of gains and losses happen. Let's go back to Air Force Ones. I borrow your shoes, sell them, and watch as the price goes up. I'm losing a fuck ton of money, so I go tell the person in charge of selling shoes, and they're like, all right, that's fun, but these hedge funds wanted to make money, so no one can sell Air Force Ones until they're cheap again. When this happens, I should technically cover my short by buying the more expensive stock. Well, whatever, that's not important. Okay, it is. It cost me more money, but whatever. We, the peasants, messed with the shorting scheme, so the overseeing organization pulled their levers to try to limit losses. The peasants were told that what they did was unethical, unsustainable, and that it hurt the master class, the hedge funders. The peasants should feel bad that people lost billions because of their actions. To explain the failure of economic principles, GameStop, a failing company, should be losing money. They drew up their deltas and gammas and showed the peasants how smart they were. The peasants may have manipulated the market, but they didn't really know what they were doing, and eventually they would lose their investments. Now, if you read anything about the GameStop affair, it was probably convoluted with words like market cap, margin, buy-up, gamma squeeze, delta squeeze, bearish, bullish, stock borrow fees, short squeeze, short book, derivatives. I could go on, but no need. If you understand the borrowing and selling of Air Force Ones, you understand the GameStop frenzy. Everything else is just noise. Professional traders were angry. They issued very serious warnings to the investors who were messing with their short selling scheme. Andrew Left, a short seller and founder of Treasury Research, formerly stocklemon.com, and known for being loud, at least on Twitter, called the Redditors behind the whole thing, quote, suckers at this poker game. Then he threw a fit and cut his losses and refused to talk about GameStop anymore. It's worth noting that Left later decided to stop his short game. Presumably, he lost a fuck ton of money on GameStop. When explaining the GameStop frenzy, economists can tell you what happened, charts, graphs, numbers, and consequences, but they can't really tell you why it happened. They can go to r/Wall Street Bets and do some research into what led to it. They can point to Elon Musk egging on investors via Twitter, or they can just call it a random act of shaking shit up. But they can't tell you why the peasants came together in such a way because the peasants' behavior is directly at odds with how the peasants should have behaved. So remember the concept of the fully rational and logical human. Regular public investors should have done nothing. If they were invested in GameStop and it was losing value, a rational, robotic investor should have dumped the stock to prevent losses. A company in decline is a bad investment, and the peasants should not invest in it. The short-selling scheme should have worked because peasants should have stayed out of it, and the peasants didn't act rationally and they disrupted the short. Economists and investors, bankers, and regulators assume or expect perfect rationality from humans in all situations. They do not expect individuals to organize in such a way that they can alter the outcomes of the stock market. Investing as a group targeting one stock or a specific few stocks makes no sense to economists because doing so would naturally drive up the price and then latecomers would be paying more to play. That's not how buy low, sell high works. You're essentially buying high, higher, and higher. That is irrational market behavior. Now, what's kind of funny is that because the peasants realized the sky-high stock prices were unsustainable, then some peasants began shorting GameStop stock. It became a whole thing. As is usually the case, the story not being focused on is a bit more interesting. Andrew Left of Treasury Research, the tantrum thrower mentioned briefly before, should be the lightning rod here. Left has branded himself an activist investor or a short seller with a conscience, I guess. As described in a 2017 New York Times feature, after he places a bet against the price of a stock, he then publishes research designed to torpedo the company's value, often by airing accusations of fraud or abuse. This is entirely legal as long as what he publishes is not itself fraudulent. According to the same article, Left is apparently also a smoker, though this is unrelated. Quote, "One morning last spring, Left and I stood in his lush backyard while he smoked a Marlboro Light." The same Times article, it goes on for a while, also offers up Left's Wolverine-style origin story. Quote, "In the mid-90s, traders were just beginning to publish their theses online. An idea occurred to Left. Take the short positions he wielded against the Long Island companies and aim them up at big companies, the more elite the better, using the internet to disseminate the research. Instead of writing in the mode of a traditional stock analyst, he would distill his arguments down to internet-friendly length. The word blog was just starting to enter the lexicon. Left registered a domain name. He decided to stay in California. He would come to talk about frauds the way surfers talk about waves." End quote. Except instead of having retractable claws and an adamantium skeleton from a military science torture spa, Left is basically just a guy who smokes cigarettes and blogs and shorts stocks. He gets corporate fraud tips from do-gooders, shorts their stock instead of, say, reporting fraud to the SEC or FBI, publishes short, readable theses on the internet, then profits from the fraud revelations. That Left finds the easy-to-read rallying posts on r/Wall Street Bets to be somehow fundamentally different from the easy-to-read rallying post on his own website should be an indicator that the fury aroused by the GameStop fiasco is, in a word, bullshit. The integrity of the market, diminished in William Galvin's estimation by cooperation among the lower classes, survives only when the market can be manipulated by a chosen few. When the chosen few are thwarted, they throw a fit. Economists do not consider important things that affect these should-be rational people, things that might contribute to their flagrant disregard for the plans of a hedge fund's shorting scheme, or the perverse joy a group of peasants may feel watching the elite investor class lose billions of dollars. One such overlooked factor, the widespread feeling that in the midst of the COVID-19 pandemic, regular working class humans were getting fucked while the super wealthy were becoming even more super wealthy. I don't think this needs a citation because we're all kind of feeling it, right? Well, here's my citation anyway. USA 2020. If you're counting, U.S. citizens as individuals received $3,200 in stimulus payments, plus some spending money for their kids during the COVID-19 pandemic, part of over $5 trillion of total aid money released. In contrast, corporations received a bit more. American Airlines received $5.8 billion in April 2020, Delta $5.4 billion, United Airlines $2.75 billion, DaVita Inc. $240 million, Ruth's Hospitality Group Inc. $20 million. The findings of a congressional investigation in September 2020 revealed gross incompetence in the issuance of stimulus aid, resulting in huge payments to corporations that shouldn't have received them. Almost $300 million went to companies and government contractors that were either barred from doing business with the U.S. government or had been flagged for performance issues. More than 10,000 companies obtained more than one loan, exceeding the one per customer limit. And in light of these outrageous errors, the humbled Treasury Secretary Steve Mnuchin, the man in charge of America's money, vowed to resign and offer his help in auditing the I'm just fucking with you. Mnuchin said the Treasury, quote, ran into a lot of issues and then probably slept just fine. I want you to remember the name Mnuchin. He's like Voldemort. We're gonna have to deal with him eventually, but right now, we're still learning wizard stuff. Meanwhile, grow.acorns.com was recommending that peasants take their stimulus money and do things like stash it away, pay off their debts, which were held by banks and financial institutions that were already receiving stimulus cash, or even save it for retirement, that is, if you can spare it. Over the years, the peasants have received tons of unsolicited advice, condemnation, and tone-deaf appraisals of their spending habits, typically in the form of short internet articles that make the rounds on Facebook and Twitter, inciting momentary eye-rolling and then becoming cynical memes. And that didn't change during the pandemic. A particularly tone-deaf, Mashable article extols the virtues of the thrifty millennial. They get roommates, use digital coupons and cashback rewards, put off or avoid life's milestones like marriage, home buying, and new cars. Never mind that as an actual millennial I can tell you these are not virtues, but rather the realities of being broke. My wife and I were roommates before we were married. We were roommates with a kid, technically. Why are millennials broke? Because they eat out too much, according to Forbes in 2016. What's killing the casual dine-in restaurant? Millennials, because they won't eat out, according to Business Insider in 2017. Nearly a year into the pandemic, Suze Orman was recommending that people hoard stimulus money, save a year's worth of salary, donate money to families in need, and take out home equity lines of credit in case you're hurting for money later. While I can applaud the thought behind giving to families in need, my wife and I did so during the pandemic, it is directly at odds with both hoarding money and the paranoid rationale behind taking out a fucking line of credit against your house. I will leave it to those more creative than I to explain how save a year's salary and take out a HELOC just in case share the same train of thought, never mind the practical limitations of being able to actually save a year's worth of your salary. If we could do that, I don't think we would need advice from Suze Orman. The pandemic response didn't have to be so juvenile. The United States government holds immense powers at its disposal for major crises. Historically, this has meant war, but it can be applied during a pandemic as well. Instead of throwing cash at corporations, which is an unsophisticated measure considering the advanced theories our best and brightest economists claim to possess, more creative solutions such as 1. Tax carryovers, which would forward losses to the next year or forward multiple years. Hint, they actually did this in the stimulus, but they also inexplicably allowed businesses to carry forward debt from previous years. Just go read the CARES Act. 2. Debt and bank freezes, which would halt corporate debt service. No more issuing loans, no more collecting payments, no accruing interest. And 3. Subsidies for utilities, maintenance, perishables, and insurance subsidies to cover power, water, gas equipment, product waste, and liability coverage for the duration of mandated shutdowns. I'm just spitballing here, but no one thought about what businesses would actually need to survive a shutdown and then, put smart people in charge of making it happen? The fact that corporations receive straight-up cash handouts is justified by the idea that corporations can't get roommates, they don't eat at restaurants, and they really, really, really needed the money. It also falls under the category, we are very rich and obviously know how to handle money, so just give us the money. Citizens were left to lose their jobs, join food pickup lines, and worry about eviction. In short, you and I, peasants, should figure out how to make the bare minimum work during a pandemic and in general all the time, adapt to being paid less, losing purchasing power, working more, and not feeling entitled to eat at restaurants. So GameStop was kind of a coordinated fuck you to the people who make money when businesses fail and to the corporations who make money while people struggle. Because in 2008, the peasants received a giant fuck you from those same people and those same corporations, and the government said, yes, fuck the peasants indeed. The 2008 financial crisis is the reason I began reading about economics in the first place. Literally overnight, new housing construction in the United States just stopped. Okay, that's not totally accurate. New home construction fell from 2.27 million new homes being built in January 2006 to just over 1 million by December 2007, and down to 478,000 by April 2009. We didn't consistently reach 1 million homes per month again until 2015. New home construction is possibly the most important metric we have for measuring the economy. People building and buying homes impacts every part of the market, from the construction workers flush with work and cash to the real estate agents signing contracts and mortgage bankers handing out loans. The demand for homes leads to a demand for infrastructure and durable goods like roads, electricity, plumbing, internet, supply chains, new cars, appliances, and heavy machinery. The commitment to mortgage payments equals confidence in job security and the promise of future growth. Up to 2008, we had been building and selling houses like crazy. It was great if you're into that sort of thing. Then, boom, dead. News networks, financial magazines, papers, scholarly articles, and racist uncles alike were suddenly talking about bursting bubbles and toxic mortgages. We didn't really know what was happening. Eventually they made a movie about it, The Big Short, which is a pretty good movie because beautiful people explain complex economic principles to the audience while being beautiful. So why have I suddenly switched from talking about GameStop to the 2008 crisis? Well, the answer is Bob Vila. But first, one more thing. What are stocks, shares, and securities? Stocks are parts of a company that you own. When a company, quote, goes public, it sells off parts of the company to the public. Shares are units of stock. Let me demonstrate these definitions in a quick dialogue. I own Google stock. How much? 5 shares. I'm a thousandaire. That's pretty simple, and maybe you already knew it. You want to know how much economists hate commoners? Let's take a look at the real definition of stock according to Investopedia. A stock, also known as equity, is a security that represents the ownership of a fraction of a corporation. This entitles the owner of the stock to a proportion of the company's assets and profits equal to how much stock they own. Units of stock are called shares. That is a pretty straightforward definition, but they've added a word that needs yet another definition: security. Here's a joke. How do economists say fuck you? They define security. Again, Investopedia. The term security refers to a fungible, negotiable financial instrument that holds some type of monetary value. It represents an ownership position in a publicly traded corporation via stock, a creditor relationship with a governmental body, or a corporation represented by owning that entity's bond, or rights to ownership as represented by an option. To understand securities, you have to know the following words and their economic definitions: fungible, financial instrument, creditor, position, bond, and option. So let's be totally honest, after hearing the definition of stock and the subsequent definition of security, do you really know what these things are, or are you just kind of nodding your head? I don't know about you, but I am indeed a head nodder, so let me break it down to you the way that I understand it. A security is something worth money, and that is it. Let's use Air Force Ones as an example again. I pay $100 for a pair of Air Force Ones and keep them in a box. Assuming that Air Force Ones hold their value, as long as I'm carrying around my box of Air Force Ones, I have the equivalent of $100. My money is secure in the value of the Air Force Ones. If I don't have $100 but want to buy something worth $100, I can just exchange that box of shoes. If someone wants to buy my Air Force Ones, then I will gladly take $100 in exchange. This might be getting redundant, but the entire point is that the box of Air Force Ones is worth $100, and anything else worth $100 can be traded for that box. Now, if the person who buys that box of Air Force Ones opens up the box and sees shitty flip-flops, then suddenly the security of $100 disappears. How much are flip-flops worth? Well, they're not worthless, but they're not worth what the buyer paid. Let's say they're worth $5. You can still put them on your feet, but other than that, they're just shitty flip-flops and $95 has simply vanished. And because the dollar value is backed by a pair of sneakers, we can call this a sneaker-backed security. And if it's only flip-flops, then you could say that the sneaker-backed security was actually a scam. Now, there might be an economist reading this and saying, that's a tangible asset, not a security. Well, fuck you too. Fine. I'm not carrying around a box of Air Force Ones. I'm carrying around a piece of paper that says I own a box of Air Force Ones. And that piece of paper is the financial instrument that represents a thing of value, the shoes that are worth $100. You can trade the piece of paper all day long, and it's as good as passing around a pair of shoes or a $100 bill. That makes it a fungible asset. Now, you want to make it more complicated? Say I borrowed that $100 from you to buy the shoes. I sign an IOU for $100, I get shoes, you get the piece of paper worth either $100 or a pair of Air Force Ones, and guess what? It's still just a fucking sneaker-backed security. You've just added paper, made it way more complicated, and that is how securities work. There are 3 main types of securities. Equity is ownership of something like stocks or Air Force Ones. Debt is money borrowed that has to be paid back with interest. Someone can buy debt and make money collecting those payments. And hybrids they are something. Only 5 people in the world understand how hybrid securities work, and they are very smart. Hybrid securities are all different, and they all have specific functions and rules. Convertible bonds are a type of hybrid security and the most common. They are a corporate debt that returns payment to the owner. That's it. At some point, you can opt to convert the debt security into company shares. A hybrid is a debt investment that can be converted into an equity investment or the other way around. That's what they are, but how they work is a mystery to all but those 5 very special, very smart people. Warren Buffett probably knows how hybrid securities work. So, stock is an equity investment, a bond is a debt investment, and a hybrid is sorcery. When money is tied up in stocks, bonds, or hybrid, they become securities, and those are stocks and bonds. Let me use another dialogue as an example. Hi, what do you do? Securities trader, stocks and bonds. Are you also an asshole? Indeed I am. And icing on the cake, whatever holds the dollar value backs the security. See sneaker-backed security, see also mortgage-backed security. Bonus, if you have a bunch of sneaker-backed securities or pieces of paper, you can bundle them up and sell them as collateralized debt obligations or CDOs. Bonus, if you organize your Air Force One CDO bundles into neat stacks of colors, sizes, shapes, and value, those are tranches. Rich people like to buy neat stacks of organized CDOs, typically arranged by interest rate, duration, value, and loan type. That concludes Chapter 1 of Unfuck the Poor. There is a graph for this chapter and several footnotes available at askaleftist.com. Chapter 2 will be released next, and it is all about Bob Vila. If you're under the age of 40, I suggest you Google Bob Vila before listening, and I know exactly what you're going to think when you hit the search button, so let me just beat you to the punch. Yes, I am talking about that Bob Vila.